Welcome back, YouTube, to this next video in our series on financial independence and investment assets. Today we're going to be talking a little bit more about stocks and derivatives, stock options, a little bit more in depth. And I'll have to be honest with you, I sat down to start filming this video and it didn't quite start to go the way I wanted it to go. So I'm going to try and retool it and talk a little bit more heavily on options and derivatives, which, to be honest, I have no experience doing, but I understand the concept, and there's a reason why I don't do it, and I'll talk about that in a second. But before we get to that, just want to remind you guys to like and subscribe, be the first to know about new content when it comes out, and keep watching my videos. Hopefully you found these informative, and you're getting a lot from them, and I'm happy to keep producing more as long as you guys keep watching. So with that being said, let's get into it. So again, we're going to be talking about stocks and stock options today. I'm going to do a quick little rehash on stocks, what they are. Basically, they're bits and pieces of companies that will trade on an open market, which you can buy and sell based on a perceived value, which will set a stock price. Now, that's basically driven by demand and supply. So the higher a stock is in demand, the higher the price will be driven up. And the idea is that you can make money off these assets by buying low, letting the company and the stocks that you, the shares of it that you hold appreciate, and over time, whether a short or a long time frame, you sell these stocks or these shares of these stocks at an appreciated value. Now, again, some of these other more developed companies will offer dividends, which are portions of profit that are paid back out to shareholders over time, and those are also driven by the performance of the company. It's not uncommon to see a company increase a dividend if it offers one if the company is doing well, and decrease it if it's done poorly. A good example of this is GE, which within the past 2 years has really dropped its dividend, which historically has been very strong, down to a minimum. I've got a few shares of GE, and I'm pretty sure I get a cent dividend per share per quarter. So it's something worth looking at, but typically these are more developed stocks, and more emerging markets and fast-moving stocks won't offer dividends. Now again, these are bought and sold in units called shares, which have historically been the smallest unit which you can buy and sell these stocks in. That's quickly changing. There's a lot of brokerages and investment banks and investment apps that will actually allow you to buy portions of shares, in which case you can actually buy larger companies which have a very high share price in bits and pieces and own a much larger company and potentially a more profitable company, which in most cases may have been out of reach. So like with any investment asset, again, I'm going to harp on this every time I can. Diversification is key. The more you can diversify, the better off you will be in the long term. And the reason for that is stocks will mirror sort of a performance of the company. The more desirable a company is, the better it's performing, the higher the stock prices will go, and the opposite is true. If a company begins to underperform or comes on hardship, that stock price will fall. Now, the thing you have to realize, and the mindset you sort of have to be in, is that when you purchase these shares, you actually become an owner of this company. So you have a vested interest in how it performs. One, because that will affect your bottom line and your profit when you decide to sell these shares. But two, you have no recourse if a company begins to fail or perform poorly because you have actually taken ownership. Legally, you're not really held responsible, but you could potentially lose a lot of money. Now, when I mention diversity when it comes to stocks, it's almost impossible not to mention exchange-traded funds. Now, to rehash on this, exchange-traded funds are basically a basket of stocks or goods or what have you that will trade on a stock exchange very much like a stock will. So this offers sort of baked-in diversification depending on what the ETF is focused on. You can do regional ETFs, so you can do like US stock market or Chinese companies traded as stocks, or you can do ETFs can be focused towards sector, whether it's financial sector, so bank stocks, technology, so like computer companies, Apple, AMD, Intel, stuff like that will all be traded at a single share price which represents portions of these companies. You can also have energy-based ETFs, utilities, and a big subset of this are actually real estate investment trusts, which are So I'm sort of on the fence of whether those are exactly ETFs or they just function like ETFs, but they're bits of real estate that will also trade on exchange. These typically will pay out dividends, which correspond to any rental income or any appreciation of that real estate back to shareholders. Now, you typically buy all of these through a brokerage, and that price that you pay is driven by supply and demand on that particular stock. So these brokerages, and until recently, brokerages will charge a fee for buying and trading stocks and ETFs and REITs. That's usually not the case anymore, and there's a few reasons for that, which I'll get to in a second. But again, you want to buy low and sell high, and the idea is that you profit off of that increase in value. So that's it for sort of the rehash portion of this video, and now we get to the meat of what I really want to talk about, which is derivatives. Now, derivatives, of course, derive their name from the fact that you can make money, and they're financial instruments that function off the performance, sort of the meta performance of these investment assets. Now, in this case, we're going to be looking at stock options, which are contracts which allow you to buy or sell a stock or an ETF or a REIT at a predetermined price at a predetermined point in the future. Now, there are two main types of options. There are call options, which are the option to buy an asset at a predetermined price at a predetermined point in the future. And there are put options, which allow you to sell that asset at a predetermined price at a predetermined point in the future. Now, you can also buy and sell these calls and puts. So there's a bunch of different ways that you can make money off this. Now, a big asterisk with this before I go a little bit in depth on explaining. I largely believe stock options to be speculative because there's no real easy way, unless you have complex computer algorithms or a really intense background into financial instruments, to gauge markets and predict markets at a point in the future accurately enough to, time over time, create a profit. Now, that's not to say there haven't been cases where people have exercised stock options and made a boatload in huge returns, but generally that tends not to be the case. If anything, you're looking at small margins that you'll run on for making these or for exercising these options. Now, that being said, the best way to sort of explain how they work is through an analogy, or basically a practical case here. So say you have a stock that's trading currently at $100. Now, you want the option, in this case, to buy that stock at the same price, $100, at a set point in the future, say 10 months from now, or a year from now. It's probably going to be an easier case to work with. Now, the idea that you're banking on is that this stock will increase in value over that period of time. So it could be at the end of a year at $120 a share, in which case you're buying in at $100 at that point in time in the future. Again, this is an option, so you don't necessarily have to exercise that option, but if you do, you'll pocket $20 automatically. Now, in order to actually purchase that contract, there is a fee associated with that. I'm not going to go ahead and hazard guess what those fees are, but it does depend on the strike price, which is the price at which you buy that asset, and the time of the future in which you want to exercise that option. Now, the idea here is that you're banking on that asset appreciating that much in the future so that you can gain that value. But it may not appreciate. So if it doesn't appreciate, or it actually goes down in value over the course of a year, say it stays at that $100 price point, or less than that, it goes to $90, you don't have to exercise that option and you don't have to purchase that stock, but you don't gain anything. At the least, or at the most, you're actually just paying the price of that contract and that's it. Now, puts work the opposite way as well. So say you have an asset, you have a stock that's $100 currently, and you want the option in a year's time to sell it at $100 as well. Now, in this framework, in this mindset, you're banking on that asset depreciating over that period of time to, say, $90 or $80 at the end of the year, so you pocket the difference if you do exercise that option to sell that asset. Now, there's one other dynamic that comes into play, which is over time, you can actually buy and sell those contracts while they're in progress before the exercise option date. So say that 6 months after you buy a call option to be able to buy an asset at a year's time, 6 months into that, it's appreciated to $130. Well, you can exercise that option to purchase it. However, you can sell that contract to someone else for a portion of that contract price or that asset price, and you pocket that difference there. Now again, these assets are highly speculative just because there's a lot of fluctuation that can happen between when you buy or sell the option to when you exercise it. And there's no real accurate way to determine whether that's going to appreciate or depreciate over time. So you could potentially lose a lot of money if only the contracts that you paid for them, the contract price and not necessarily the assets. Now, the real loss will come into play when you decide to sell these options, which requires that you are actually holding the asset prior to exercising the option. So this is like if you are selling a call contract. Now these are done covered or uncovered, and that just refers to whether you actually own the asset or not. So this applies to selling calls or buying puts. Now that means you will typically have the asset to actually eventually sell the other person on the other end of this contract. Now let's take the example of selling an uncovered call. Now if you're selling this call uncovered, means you don't have the underlying asset. Now the contract terms are going to be the same. The asset is currently trading at $100, and the contract is for a call at the same price at a year's time. Now, if you're selling this contract, you're betting that in that year's time, the asset will actually depreciate, so it may be trading at $90. So you can buy that asset and turn around and sell it for $100 to the person who buys that contract, in which case you will pocket the difference. But the buyer of the contract is banking that the asset will actually appreciate over time, so it may be trading at $110 or $120, in which case they can buy it at $100 and pocket the difference. Now, if the buyer's assumption is true and you're selling an uncovered call, that means you actually have to buy that asset at that higher active trading price of $110 or $120 and sell it back to the buyer of the contract for $100. So you've lost not only the contract, but the difference in price of the actual trading asset and what you've promised you'd sell it to the buyer of the contract for. Now this is where it gets, where you can lose a lot of money with options very quickly, especially selling uncovered calls or buying uncovered puts, because then you don't actually have an asset to sell if you want to sell the asset in the future in a put. So these are all sorts of dynamics you have to take into play. There's a bunch of options you can, and I'm not even using this as a pun, there are a lot of options you can exercise, whether it's buying calls or puts or selling the same. A lot of dynamics at play and a lot of numbers you have to keep in mind when it comes to contract prices and potential asset prices in the future. Now again, I want to put this huge asterisk on here. This is pretty much speculative. Again, there have been cases where people have made a lot of money trading these options, but by and large, you're not going to be running on huge margins, so you'll have to trade in volume to make up that difference if you intend on making a lot of money in the short term. But being a buy and hold investor with just straight stocks, I recommend avoiding it. But it's up to you. It's up to you to do your own research and make your own decisions and take that risk that's associated with exercising stock options. Now in closing, hopefully this is going to be another short video. Like I said, the original idea for this video sort of evolved over time. I didn't want to be rehashing a lot of the previous information that I talked about previously. So I just sort of gave you a bare bones on how stocks work and dedicated a lot of this video to stock options. Now, I'm going to go back to what I do every time, which is plug the investment apps that I have down in the description of this video. And one I want to pay close attention to is Robinhood, because Robinhood is not only a brokerage in which you can buy and sell individual stocks, you can also trade options on Robinhood. So if that's something you want to explore and you're a beginning investor It's a good place to get started, get a hold of how the market dynamics work to begin with, and exercise options. Why not? You only live once, I guess. Give it a try once or twice. So one interesting thing to note about Robinhood that I actually sort of mentioned earlier, but I didn't use any names with it, is Robinhood was actually one of the first investment apps and investment brokerages to actually offer no-fee trades. And interestingly, over time, that drove a lot of larger traditional investment brokerages like Fidelity and Vanguard and a lot of those banks to eliminate actually some of their fees that they charge for trading. I think Schwab was the first one, and within a week, the rest of the traditional brokerages decided to drop the cost of their trading. So with that being said, that sort of wraps up what I wanted to talk about today. Again, like and subscribe if you like the content. I know this video was probably not what I was expecting, and it may not be what you're expecting. But again, if you like the content, bear with me. Hopefully I'll have some better videos coming out in the future that talk a little bit more about different assets and a little bit more nuances on how to go through everyday life with a bit of financial advice. Like and subscribe, and thanks again for watching.